Warren Buffett once wrote a check for about $1.3 billion to buy shares of Coca-Cola. Not exactly shocking, right? A soda company, safe and boring. But here's the twist. That one purchase now spits out over $700 million in cash every single year. And Buffett hasn't sold a share. His yield on cost is north of 50%. That means every 2 years, he's effectively repaid his entire original investment just in dividends. How does something that boring become one of the boldest, most transformative investments in history? Today, we break down Buffett's Coca-Cola bet. The purchase, the math, the dividends, the compounding, and the ways this one decision helped reshape Berkshire Hathaway's future. Quick favor. If this kind of deep dive helps you sharpen your investing skills, hit like and subscribe to 7 Hills Equities. It really helps the channel grow. It's the late 1980s. Coca-Cola is over a century old, and it's everywhere. You can buy a Coke in Beijing, in New York, and in tiny towns across America. Pepsi is the rival. The cola wars are real. But Coca-Cola owns mindshare, distribution, and an advertising engine that keeps customers coming back. Buffett saw something most investors miss. A brand moat so wide you couldn't see the other side. He famously said that if you gave him $100 billion to knock Coca-Cola off its pedestal, he wouldn't know how to do it. That's not arrogance. That's an observation about scale, habit, and pricing power. In 1988 and 1989, Berkshire Hathaway quietly accumulated about $1.3 billion worth of Coca-Cola stock, roughly a 6.2% stake. For Berkshire at the time, that was massive, about 40% of the stock portfolio. Buffett wasn't dabbling, he was making a statement. This was the kind of business worth owning for a very long time. Let's talk numbers, because this is where the magic lives. Back in 1988, Coca-Cola's dividend yield hovered around 3%. That meant Berkshire's $1.3 billion stake produced roughly $40 million a year in dividends. Not bad for a starting point. But Coca-Cola didn't stand still, and neither did its dividend policy. Year after year, Coke increased payouts. Decade after decade, the checks grew. Today, Coke is a dividend king with over 50 consecutive years of increases. So what does that mean for Berkshire? That original $40 million has swelled into more than $700 million in annual dividend cash. Every single year. And that's just the income side. The equity itself appreciated dramatically. That $1.3 billion position is worth well over $25 billion on paper today. Sum up the share appreciation plus the mountain of dividends Berkshire collected over time, and you're looking at a return that's simply historic. Buffett's favorite holding period is forever, and Coca-Cola is the poster child of that mindset. He didn't trade in and out, he didn't try to time the market, and he didn't hedge away the volatility. He treated his shares like ownership in a cash-generating business and let compounding do the heavy lifting. But this wasn't a decision made in a vacuum. A few important context pieces make the choice clearer and more dramatic. First, consider the timing. Buffett began building Coca-Cola not long after the 1987 market crash, when fear was thick on Wall Street, and many investors were retreating. The crash had shaken confidence. Investors were asking hard questions about future demand and market resilience. Buffett saw the panic as opportunity. He doubled down when others hesitated, buying the kind of durable consumer franchise that historically bounces back. That timing underscored his conviction. Great companies survive and often grow stronger after shocks. Second, think about the psychology involved. Owning a position that multiplies in value is an emotional challenge as much as an intellectual one. When Coke doubled and then tripled, the urge to lock in gains must have been enormous. Most investors would have been tempted to sell chunks, to realize profits, to redeploy into the shiny new thing. Buffett didn't. He kept seeing Coca-Cola for what it was, a perpetual cash machine. That mindset, the discipline to hold when the world screams, "take profits," is rare, and it's a huge part of why the outcome looks so impressive in hindsight. There were also real crises and narratives that could have justified selling. During the dot-com bubble, consumer staples were called boring and out of favor. In 2008, Coke's shares fell with the market. Health trends and sugar concerns kept surfacing as reasons soda might be a fading product. Yet Coke's brand, distribution, and product ecosystem continued to generate reliable demand. Those recurring doubts made holding tougher, but they also highlighted the difference between temporary noise and durable business advantages. Here's another dimension that often gets overlooked: what Coke's dividends actually did for Berkshire. That $700 million a year didn't sit idle. Berkshire redeployed it into railroads, insurance operations, other equities, and occasional acquisitions. In effect, Coca-Cola became not just a source of profit, but a financing engine for Berkshire's broader expansion. The dividends provided optionality, cash to act quickly when opportunities showed up. So Coke's compounding effect wasn't limited to Coke itself. It multiplied through the capital allocation choices Berkshire made with the cash. Now let's compare Coke to two other legendary Berkshire holdings, American Express and Apple. American Express goes back to the 1960s, when Buffett bought in after the salad oil scandal. He recognized the brand loyalty and network effects Amex enjoyed. Berkshire's Amex position has been a steady, long-term performer and an example of buying quality at a time of distress. But the dividend story is simply not as dramatic as Coca-Cola's. Amex is more about durable earnings and franchise value than a high-yielding income stream. Apple, by contrast, is Berkshire's modern crown jewel. Buffett started buying Apple in 2016. Apple's capital appreciation has been staggering, and in raw dollar terms, it dwarfs Coke. But Apple's dividend yield is modest, and the business is a different beast. High growth, ecosystem lock-in, and significant earnings reinvestment. Apple is a phenomenal capital gains machine. Coca-Cola is a phenomenal income and durability machine. Both fit Berkshire, but they showcase different ways great companies compound value. As an investor, that's a crucial point. Great investing isn't one size fits all. Sometimes you seek growth, sometimes income, and sometimes you want a mix that funds other opportunities. Coca-Cola delivered the kind of predictable cash flow that allowed Berkshire to think bigger. Let's do a quick thought experiment. What if Buffett had bought Pepsi instead? PepsiCo is a formidable company with a broader snack portfolio and its own moat. But Pepsi's business mix, heavy on snacks and food, changes the dividend profile and volatility dynamics. Buffett wanted the pure beverage play. He wanted a steady, predictable, global cash cow. Coca-Cola's singular focus on beverages, its distribution muscle, and its advertising-led brand loyalty made it the cleaner match for Buffett's forever thesis. The choice wasn't merely taste, it was a strategic alignment between company dynamics and investor intent. What practical lessons should you take away from the Coca-Cola story? 3 concrete things. First, brand moats matter. Look for companies with repeat purchase behavior, strong pricing power, and distribution advantages. These create durable cash flows that compound over long horizons. Second, don't underestimate dividends. Total return is price appreciation plus income. A growing dividend stream can transform the investor experience by providing tangible cash that funds other opportunities or compounds into greater wealth. Model yield on cost over long horizons, not just current yield. Third, patience is a competitive advantage. Many investors are right about a stock's potential, but wrong about their ability to hold through the noise. Being right and staying invested are two different skills. Practicing disciplined holding, while periodically reassessing the thesis, is what separates compounders from traders. And here's a practical application. When you evaluate a company today, simulate 2 scenarios. One where you sell after a 2x or 3x return, and one where you hold for decades and capture dividends and reinvested cash flow. Compare the outcomes. The Coca-Cola story practically screams for that kind of simulation. The Coca-Cola investment wasn't flashy, and it certainly wasn't timed to perfection. But it was transformative. A $1.3 billion check turned into more than $25 billion in equity value and produced a $700 million annual dividend stream that helped fund Berkshire's growth for decades. More than a home run, it was a perpetual cash machine that gave Berkshire optionality and stability. Buffett once said his favorite holding period is forever. Coca-Cola shows exactly why that philosophy works in practice. Steady business economics, relentless dividend growth, and the discipline to hold through uncertainty. If you enjoyed this breakdown, hit like, share it with a fellow investor, and subscribe to 7 Hills Equities for more stories about legendary investments and the lessons they hold for your portfolio. And tell me in the comments, would you have held Coca-Cola forever, or would you have taken profits along the way? I'll pin the best responses. Until next time, stay patient, stay curious, and keep investing wisely.